Hey folks, CA Rachana Ranade here and I welcome you all to yet another shoot and release video, but a fundamental analysis video comparing two different companies. One is Polycab and one is KEI. I'm doing this after a long time. I'm going to enjoy this. I hope you will enjoy it too. But what are we going to cover essentially in today's video? For that, if you have a look at this, you will understand we are going to cover three key points. Number one, we'll talk about how the business of Polycab is different from KEI. We are going to talk about the Q1 highlights. We are going to talk about management commentary, their long-term guidance, their capex guidance, both for Polycab as well as KEI. And ultimately, we'll try and answer the question, Polycab versus KEI, who is winning? But before we move on with the entire analysis, this 15th August, celebrate freedom with financial wisdom. Please don't forget to use the coupon code AZADI while you enroll for any of our courses. Always remember that, if you invest in knowledge, it is going to give you the best returns. That is what Mr. Warren Buffett has also said. So I'm going to give the links of our websites. Both you can check out rachanaranade.com or rachanaranade.in. Both link websites in the pinned comment and in the description box below. With that, let's get started. First things first, we are going to talk about Polycab India and we'll understand about how the business model of Polycab is different from KEI. Now, if you see here, for Polycab, 84% of their revenue comes from the wires and cables segment. 7% revenue comes from FMEG, that is fast moving electrical goods, and EPC is 9% revenue. Okay, but if I check for KEI Industries, wires and cables itself contributes to 93%, 7% is EPC, and if you see one segment is missing, which is FMEG. That's how Polycab and KEI are different. FMEG is a part of Polycab, it is not a part of KEI Industries business. Okay, so now let's understand about the Q1 results of Polycab. You will see here I have compared June 25 numbers with June 24 numbers. You will see a YOY, you will also see a QOQ. But being a kind of a seasonal business, we are going to focus more on YOY numbers. Now, if you see here, sales up by 26%, EBITDA up by 47%, EBITDA margin up by 212 basis points. I hope you already know this, 100 basis points is equal to 1%. So, EBITDA margin, there is a 2.12% uptick. We also call this as a margin expansion, right? If you see net profit up by 49%, PAT margin 1.6% up move or uptick, you can see that again a margin expansion at PAT level also, and EPS up by 49%. All in all, do the numbers look good? Absolutely yes. Now this is about overall numbers. Now let's try to break it down based on their segments. Now if you see wires and cable, and if you remember that was the most important part of their entire revenue breakup. Revenue is growing at 31%, EBIT is growing at 51% and EBIT margin also growing or there is a margin expansion at EBIT by 190 basis points. So, almost 2% increase in EBIT margin is a good sign. Second important revenue, segment wise revenue, you can see here it is for FMEG category, 18% growth in revenue, EBIT up by 417%. And why is that so big? It was in losses in Q1 FY25, now in profit at 9.6 crores. So, good uptick in EBIT as well. EBIT margin also up by 2.8%. EPC not a significant driver for them. Their revenue is down by 19% though. EBIT is down by 31%. Margin is also down by 140 basis points. This is about segment wise revenue. So now what are we going to check? We are going to check their management commentary. In that we are going to talk about three aspects. First we will talk about what is the current situation as per the management. Then we will talk about what is their view on capex, what is their capex guidance, and we will also talk about what are their thoughts on exports. But first things first, we will talk about what is it in the current quarter. So we will talk about all three segments, wires and cables, FMEG and EPC. What does the management say? Wires, we saw high growth. Why? Because of higher government expenditure. Obviously, because of more government expenditure, especially on infra, something like housing, wires and cables is going to see a good demand, right? Better project execution and rising commodity prices. See, if commodity prices are rising and if they are able to pass on the benefit, of course, their sales is going to increase. For FMEG, they are saying fan segment witnessed a muted performance. Why? Because we had a shorter summer season this year. Especially if you are from Maharashtra, I'm sure you'll agree with me that in the month of April, it was so hot. It was, we all were like, if April is so hot, what is going to be the case in May? But May started with monsoons. So May season we started having this nice rainy season weather. So overall, we were happy, but not a company like Polycab where FMEG could get impacted because of a shorter summer season. But On a positive side, they are mentioning that solar products, especially the solar inverter, they are saying that entire solar products range saw a 2x year-on-year growth, which is again a good sign for them. They mentioned that FMEG is a category where they saw second consecutive profitable quarter. Again, good point for the company. For EPC, they are saying that we are seeing a sustainable operating profit margin and a high single digit over mid to long term. Okay, that's about the EPC segment. Now let's talk about a longer term guidance. For cable and wire, they are saying we are expecting a 11 to 13% EBITDA margin guidance. And for FMEG segment, they are saying that whatever is the industry growth, we expect 1.5 to 2x of the industry growth. So they are saying we'll essentially grow at a faster pace as compared to the industry. And they are also aiming for 8 to 10% EBITDA margin for FMEG by FY 2030. Okay. Now that we know what happened in Q1, management guidance for management explanation for that, management commentary for that, we did talk about long-term guidance. Now let's also understand about their capex plans. For capex, they are saying that we already did a capex of 410 crores in the first quarter, and over the next 5 years, we expect to do a we will do a capex of 6,000 to 8,000 crores. That's what their management says. This translates to roughly 1,200 to 1,600 crores per year capex, roughly. Okay. And where is the capex, large capex going to come from? They are saying large part of this capex will be in the cables and wire segment, some in backward integration, and small part for FMEG. All this said and done, what about exports? Currently, out of the total revenue, 5.2% is the export revenue. So let's say 100 rupees is the revenue, roughly 5 rupees comes from exports. Out of that, US is the largest consumer and 1/3 of export comes from USA. So again, let's understand, total 100 rupees revenue. Out of 100, 5 rupees comes from exports, and uska 1/3, so somewhere around 1.6 to 1.7 is coming from USA. So is that like a crazy exposure to USA? Answer is no. But the management is saying that in the longer term, US will be the largest opportunity. Now, if you are confused that, but because of Trump tariffs, it is going to see a negative impact. Maybe in the shorter term, yes, but Trump is not going to stay forever, right? Total 4 years term, out of that one is almost over now. So balance 3 years remaining. If they get hopefully a better president, then they will be able to actually have a better prospect in the US in the coming years. But is there any other demand driver? Absolutely yes. They are saying that data centers, power infrastructure, it has become quite old now, 60 to 70 years old, and that will require upgradation, and because of which, again, there will be a good there will be a good demand in the wires and cable segment. What about Europe? They are saying that Europe is not very pro-China. They always seek for alternatives, and they have also observed that China has not done a lot of dumping in Europe. Having said that, can Polycab have a good opportunity in Europe? Answer is yes. Okay. What about Middle East? Yes, again Middle East also, they are saying that we see a huge demand for cables, especially due to significant infrastructure investment. So all in all, for exports, they are pretty much bullish. Let's see how things turn up in the coming few years, right? This was about Polycab. Now let's have a quick snapshot of KEI Industries as well. Now first, as I did for Polycab, first Q1 results, again we are going to focus more on YOY. 25% YOY increase in sales, EBITDA margin up by 18%, EBITDA up by 18%, EBITDA margin by 64 basis points. By the way, it's not an uptick, it's a down move, 0.64% decrease in the EBITDA margin. Net profit up 31%, PAT margin up by 31 basis points, EPS 22% up move, not bad, right? Here I am not going to go into the segmental revenue. If you remember, I talked about wires and cable, then FMEG and EPC for Polycab. But for KEI, it's just wires and cable, which is 93%. So I'm not going to go into, again, segmental revenue, doesn't make sense. So directly let's jump on to management commentary. They're mentioning that there is a pending order execution for 3,921 crores, and they are saying that we'll be able to execute this in the next 3 to 4 months. So maybe in the next quarter, or maybe in split in the next quarter and uske baad ka next quarter, they should be able to recognize this revenue of 3,921 crores. That's what the management is mentioning. They have also mentioned that they have already incurred a 410 crore ka capex in the first quarter, and in the next 9 months they are saying that up to 600 to 700 crores is what the capex that they have planned. They are mentioning that not only in the next 9 months, but we will do 600 to 700 crores of capex annually so that we can maintain the 20% top line growth. Now, just in case if you are new to this entire fundamental analysis thing, always remember, more capex ideally should lead to more revenue. How? More capex is what? More factories, more plant and machinery, more production capacity, ideally more production, ideally more sales, more top line, ideally more profits. Is the logic clear? Yes. Now, out of this 600 to 700 crores, they are saying that majority of that is going to happen in Sanand commercial production. This is a place in Gujarat. They are currently deploying a lot of capital. They are doing a lot of capex for this Sanand commercial production, and they are saying that the whole project should be completed by H1 FY27. So basically, financial year 26-27, uska H1 means till 30th September 2026. Ideally, the full project should be completed. And they are saying that, okay, this will be completed by H1 FY27, but they should be able to ramp up to full utilization in the next 3.5 years. Achha, please understand this. Even though the entire facility is completed by H1 FY27, they will not go to 100% production same year. No, they will slowly increase to 100% production. And how much years will that take? 3 to 3.5 years. Once they reach full capacity, that is when I can say that, okay, that will lead to more fuller capacity utilization, more revenue, more profitability. Simple to clear. Now, let's understand what is the sales growth target given by their management. They are saying that ideally 18% growth for financial year 26, but they are saying we will aim for more. Next 2 to 3 years, they are saying sales should ideally grow at 20% CAGR, especially post Sanand. They should be able to get to 20% plus YOY growth. And EBITDA margin guidance they have given at 10.5 to 11% for the margin guidance. Now, ultimately, let's come to the final face off, Polycab versus KEI. What is the scenario? If I am talking about Polycab Q1 revenue growth YOY 26%, KEI 25%, Polycab is the winner. Q1 profit growth YOY 49%, KEI 31%. Again, Polycab is the winner. FY26 revenue guidance, Polycab has not given that. KEI says 18% plus. Ideally we should get, and if you remember, they had mentioned that post Sanand they should be able to grow at 20% plus. But currently we have taken it at 18% plus. Though they have not provided this, what in such case what can you use as a base? I can say, okay, last 3 years they have grown at 22%. So I may consider 20 to 22% here. But if you feel I should not do that, okay, not provided, ignore. Okay. Next one is wires and cables segment EBITDA margin guidance 11 to 13%, and here they are saying 10.5 to 11%. So ultimately here again we are saying Polycab ideally is the winner based on even EBITDA margin guidance. Now comes an important point, average capex plans. If you remember, management had talked about 5 years. 5 years ka I have taken it at, divided by 5, I have taken it at 1 year, roughly 1400 capex plan for Polycab per year, average I am talking about, average per annum capex. KEI 650 crores. Now, what is the fixed asset turnover ratio? For Polycab, they have not mentioned, management hasn't mentioned about FATR. So, what I did last almost 8 years, what has been the FATR for Polycab? It has ranged between 4.5 to 5.5. So, I have taken it as an average of 5. Whereas for KEI, management has very clearly mentioned that because of Sanand, we should be able, because of the additional capex that we are doing in Sanand, we should be able to achieve at least a 3 ka FATR. So, that's what I have mentioned here. With this fixed asset turnover ratio, I hope you know the basic. With that, the revenue potential with 100% utilization should be around 7,000 crores of additional revenue potential, and for KEI Industries, it should be an additional revenue potential of 1,950 crores. So, again, Polycab is the winner. And long-term revenue growth, KEI has guided for 20%, whereas Polycab has not given any guidance. Again, you may say 20 to 22%, but if you feel I don't want to do any assumptions, fair enough, your choice, right? All in all, on majority of the parameters, Polycab is the winner. Even if you check ROE, ROC, both Polycab is good. If you feel that, Rachana, we should compare it on few more parameters, definitely let me know in the comment section below. All said and done, don't forget that 2 big players, which are these? One is Ultratech and one is Adani. Both have entered this space. So, could there be some disruption in this space? Answer is yes. But just keep this in mind while you take any of your decisions. But what do you feel, which stock is best? Do let me know in the comment section below. Like I told you, this 15th August, don't forget to upskill yourself. I've given the links in the pinned comment and in the description box. I hope you enjoyed today's video. If you did, please don't forget to smash the like button. Please don't forget to share this video with your friends. I'll see you in the next one. Till then, take care. Jai Hind and bye-bye.